Welcome to It's Only Money here on Real Radio 104.1. I'm Ryan Holmes, and with me is financial advisor Scott Brown of Edgewater Family Wealth, and his right-hand man, Tammy, joins us this morning as well. EdgewaterFamilyWealth.com is the website, and it's another beautiful day out there, and we always start the show with the numbers with Tammy. That's right, I'm just jumping into it.
Yeah.
You know,
I just like to play the song. I got so excited. I skipped the "How are you doing, Scots?" all the other stuff.
I'm fine. Don't worry about it, Ryan.
This section of the show is so popular that people just like just give me all the Tammy.
Yeah.
More Tammy all the time. Yeah. So when that music comes on, I have to resist every impulse I have to do the old man dance, the awkward, embarrassing old man thing that men, at weddings, like you see the old guy dancing at the wedding.
Yeah, I do that a lot.
And there's an age where it's okay. Like if you're a young man, you're in your 20s, dancing is okay. And then like when you're 75 or older, it's cute.
Yeah.
Everywhere in between, it's just awful. So don't do that.
I'll remember that.
Yeah.
So we'll kick it off with earnings. Earnings season is upon us now. This is where you can tell what all the businesses, what the release numbers of their revenue, their earnings, and they also adjust what they call a forecast for the next quarter and next year.
So that's when they predict, they tell the media or the Wall Street types, this is what we think's going to happen.
Yeah, based on the numbers at hand. And you can see that when you go online and see what they file for their income statement.
Do you think CEOs manipulate that a little bit where they'll understate what they think so they can beat? So they can beat what they said, and then everybody's like, "Yeah, you beat what you said," even though they knew all along. I'm not saying that's a thing, but that might be a thing.
That is, it's actually a thing.
Yeah. No, it's actually a big thing. I'm being a little silly here, but no, it's a big thing.
Because there's something called endnotes where there's a lot of numbers in these financial statements.
Yeah.
But there's a lot of them that could mean one thing or another. But there's an explanation that is in the endnote, which sometimes the endnote itself is bigger than the statement.
Yeah, well, my favorite is that they say, "Well, we were right, except this thing happened. Like we were gonna hit our numbers, but then the government did something, or the dog ate my homework, kind of stuff." So what you're saying is you missed your numbers, right? So ultimately, they have a reason. I was right, except I wasn't. Yeah, right. It's human nature. Again.
But it's not as bad as there's not two sets of books, right?
No, because after
unless you're Enron.
Yeah, but that's almost what it sounds like. It's like, well, if you look at this book with these numbers, good. These have the same numbers over here.
Yeah. So there's an art to it. Some CEOs are better at it than others. Some can kind of convince their audience that, wink, wink, I think we're going to be at 58 cents a share, but, deep down inside, everybody knows they're going to be at 60. But we all just agree to accept that so that when you do beat your estimate, everybody's really happy and excited for you. So, there's a little bit of that.
Yeah. I can't speak for that, but
it's okay. Yeah. I did it for you.
So, for sectors, we are, not everything has yet released their earnings, but one notable section here in such market environment right now is financials. Mm-hmm. And so far, we have about 25% of all the companies in S&P 500 reporting their earnings. Mm-hmm. In the financial sector. It doesn't look great, let's say. Mm-hmm. Like half of them kind of missed their revenue estimates. Yeah. Which is not unexpected, especially at this time when interest rate is going higher and higher, because that is reflected mostly on the financial sector. Yeah. Other than others.
But doesn't the worm turn there? Eventually rates get higher and higher. That's more they can charge on mortgages, and the delta between, say, what you're charging a young couple for a mortgage at 6% and what you're paying on a CD at 3%. Doesn't that begin to help the banks and alike out?
It would help in a little bit longer term, but for now, because all their forecasts usually they do it based on the numbers at hand and where they see it going. Yeah, and such increase at such rapid pace, can't be seen.
Yeah, gotcha. So what you're saying is overall financials have struggled to meet numbers.
For now.
50%
of them so far. So,
Any other industries in that category? Or
we are seeing, IT is doing well so far, but we only had 5% reported their earnings.
Right, so it's not far from conclusive.
Yeah.
Well, speaking of numbers, I'm going to shift gears on you You weren't expecting this, but here I go.
Let's
talk about bonds.
Oh, okay.
There's a mystery because we talk about stocks a lot on this show,
a lot of
right?
stocks.
But there's also bonds out there, and first of all, I don't even know that a lot of people understand what a bond is, right? It's so. A bond.
Does Ryan know what a bond is?
Ryan, of course, knows.
Of course, I do.
Ryan knows everything.
You've got your James.
Mm-hmm. Yeah.
You've got
Jimmy Bond.
Jimmy Bond. Yeah, of course. It's a financial debt instrument.
Oh, look at
wow.
I did not see that coming.
Man.
So a bond is a finance. So it's an IOU. It's a debt. Coca-Cola wants to build a distribution warehouse outside of Atlanta. They'll float a bond. They say, look, you give us $3 billion to build our distribution plant, and we'll give you 5% interest for 10 years, blah, blah, blah. So that's how a bond works. But where I think the mystery is in bonds is bond pricing, right? So mark-to-market type pricing. And you say, well, I bought a bond, and I paid $100 for it. And it was going to pay me 3%. But then the next day, the Fed raised interest rates, and my bond dropped to $95. Why did that happen? Why did that happen, Tammy?
So, to avoid going into very technical details.
I'm not that bright, so stay with me.
Let's think about it this way. You have this bond that you bought at 100, and the next day you said?
It was 95.
95.
Because the Fed raised rates. Is that Jay Powell's fault?
Well, it's not really anybody's fault.
Oh, okay. Because we got to blame people,
Yeah,
right?
we got to
Ryan?
blame somebody.
Who can we blame?
I don't know. Biden now seems.
I did that. I made your bond price go down.
I did that with your bond price.
Oh, that's right. You're welcome. Anyway.
So now any new bond that is going to be issued will have to add to the previous yield in order for it to be competitive. So now this person who bought that bond, they said the yield was 4. So if he's going to be buying another bond from Bank of America, that bond is going to be at a higher yield.
Yeah.
So nobody wants the bond at a lower yield right now.
So the bond he owns at 4%, nobody wants that.
Right now.
Because the new bonds are at 5%.
Yes.
Why would I want your bond?
Exactly.
Right? So why did it drop to 95?
Well, that is demand, supply and demand, basically.
So, I think of it this way. So if the new bond's at 5%, nobody wants my 4% bond. But I tell you what, I'm going to cut you a deal on my 4% bond. I'm going to give it to you instead of for 100, I'm going to give it to you for 95. Therefore, bringing my effective yield back to 5%, which was what you were going to get on the other bond, right? So bond rates, people can't see me in radio land, but bond rates are and bond prices and interest rates are like a teeter-totter. If rates go up, the other side goes down, right? So bond prices drop when rates go up, right? Because the existing bonds are no longer as valuable because the new rates that people can go to the store and buy are at a better rate, yes?
Exactly.
So to fix that discrepancy, if you will, then why would anybody buy that bond, right? If they can go get the new ones, yeah?
Yeah, but now the investors who are sitting on the side knowing that, or not knowing that, expecting or for any other reason, now they have the chance to go and buy that $95 bond that had a 4% coupon for a higher yield.
Yes, because the price is lower, the yield is higher, yes?
Exactly.
Because they're paying a discount. And the other part is there's something called accretion, Ryan, which I know you know what that means.
Yeah, it's when I don't fold my clothes right away. I get my laundry.
You get accretion, yes. I was going to make a joke about ointments, but that seemed like a bad idea. So there's a thing called accretion, right, where if you have a $95 bond, what will it mature at? When it matures, assuming it doesn't default, what will it mature at?
It will always mature at face value. That is $100.
Right. So in my example, that's $100. So not only do you get the yield in buying the discounted bond, but you get the $5 it's going to grow back to, right, when it goes back to 100 at maturity. So a lot of times people look at their statements. They come in, they buy a whole bunch of bonds. They're excited. I'm going to get 3.5%, whether it's, maybe it's tax-free, maybe it's 4% taxable, whatever the number is, and they're excited. They see the yield. They put in $1 million. It's going to pay them $40,000 a year in dividends. And then 3 weeks later, they call up and they say, "Hey, buddy, the $1 million I gave you is only worth $950." And then I say, "No, it's not." And they say, "Yes, it is. It's right here on my statement." And I said, "Look, I don't care what your statement says. Your portfolio is worth $1 million. Well, how do you figure? It says right here on the statement, they're all worth $95, and the total value is $900. Well, listen, that's today, right? That's the value today. If you sold those bonds today because rates went up, then that is, yes, what you would get. But if you hold them to their term, whether that term's 2 years, 5 years, 7 years, or 10 years, you're going to get the interest, yes, or dividend, and you're going to get $100 per bond back, assuming they don't default, right? So what happens with bond investors I wrote a piece in my book, and I referenced Tom Petty's song, "The Waiting is the Hardest Part," right? And people struggle with the waiting. The waiting is hard because, again, if you see your bond at 92 or 94 or 93, you get nervous, and you're like, oh, maybe it's going to go to 50. No, probably not. But the bottom line is if it doesn't default, it will be redeemed at the price you paid for it, right? So don't get all bent out of shape if you go buy a bunch of bonds and you put $100,000 in and now it's worth $97,000. Don't freak out and sell them because you just took $3 out of your own pocket per bond. Yes, I don't know if that makes sense to the people at home, but the reality is bond prices work inversely to interest rates, and people often get confused. Why is that? Again, because the new bonds are paying more than the old bonds, and nobody wants your old bonds unless you discount them. And that's how mark-to-market works. What would you get for it today? And I would argue if you buy a portfolio of bonds and you ladder them out and you say, I want some coming due in a year, some coming due. Let's talk about that. Let's talk about why people ladder bonds, right? You say, well, I don't know what interest rates are going to do, which is a fair thing to say because none of us really do. I know many people like to pontificate that they do. But the only people who know what interest rates are going to do near term, and they only know near term, are the people at the Fed. Yes?
Pretty much, yeah.
And they keep it a secret from me as far as I know. So when we come back, I'm going to talk about why people would ladder bonds.
And we'll be right back with more It's Only Money with Edgewater Family Wealth Financial Advisor Scott Brown on Real Radio 104.1. Welcome back to It's Only Money on Real Radio 104.1. I'm Ryan Holmes, and I'm here with financial advisor Scott Brown of Edgewater Family Wealth and his right-hand man, Tammy, and we are doing it big on a Sunday morning. Now, let me ask you a question, because the one that I was left with, and you kept saying, if the bond doesn't default, how common of an occurrence is that?
Not very.
Okay.
Not very. Very, very small, less than, I would say, 1% of bonds on average, including junk bonds and things like if you lump them all together in an aggregate default. Tammy, do you know the default rate on even junk bonds is probably not super high?
I don't know really that, but we know that we usually, whenever we invest, it's always investment grade.
Yeah, most reputable firms, and there's a place for junk bonds, which everybody's scared of. That's really just
well, the name junk bond doesn't inspire a lot of confidence.
It's not an inspiring name.
Sometimes they use high yield.
Yeah, some people say high yield to make themselves feel better. But junk bonds are really just bonds that are rated BBB or less, which is below what we call investment grade in the business. But yeah, I mean, and we were talking about laddering bonds, which is a kind of a weird term people hear, and they're not quite sure what does that mean. And so if we agree we don't know exactly the long-term nature of interest rates, which I think is a reasonable and humble thing to say, not to mention accurate, say, look, I don't know for sure what rates are going to do because rates are determined by the economy, inflation, stagflation, deflation, whatever inflation you're in favor of, that determines how the Fed reacts. The Fed reacts based on the economy, et cetera, et cetera. We don't know how that's going to play out. So, but we ladder bonds because we're not sure. And we might say, look, if we have $100,000 and we put $10,000 in a bond that's coming due in a year, that's coming due in 2 years, one's coming due in 3 years, so on and so forth, all the way to 10 years, that's a ladder. They call that a ladder. And the reason people do that is because if they're not sure and they think, hey, rates may go up, and then I'm stuck with this thing paying me 3%, but if I have a bond coming due every year, if rates go up, I can take that money that comes due each year and invest it in the better bonds, right? So subsequently, I'm tacking on to the other end of the ladder, and every addition I make to the ladder at the higher rate brings the net yield of the whole portfolio up. Does that make sense?
Yeah, pretty much, yeah.
Yeah, so that's why people ladder bonds. But you were making the point, Tammy, kind of the inverse of what I was describing, which is to say if rates go up, bond prices go down. But sometimes the opposite happens, right? We've been through a period recently, yes?
Yeah, usually the past few years we had a very low interest.
Yeah.
So anything that had a good yield was more expensive. We're paying a premium on it.
Yeah.
Above the 100.
Like $105 or $110.
Pretty much.
And you go, why would you buy a bond that comes due at 100 for 105? That seems crazy, right?
Yeah, it does. Now, but when you look at the yield, which is the very important bit, and you'd see that bond is paying you for the money you're investing.
Yeah.
So, yes, you're redeeming that at 100, but that $20 is also getting back to you using the yield on an annual basis, basically.
And that's the opposite story, Ryan, which is to say that if rates are 2, but there's a bond out there paying 5, you're like, oh, I want to get 5. But the guy or gal that owns the bond isn't stupid. They're like, I got the 5. You want the 5? You're going to pay 110 for it or 115 for it, right? Which effectively decreases your yield when you pay a premium for a bond. But at the end of the day, people need to understand that's how that market works. You can buy a discount bond. You can buy a bond at par, which is the value it comes out at when it's issued by the company or the municipality. And we'll talk about municipal bonds in a second. Or you can pay a premium if the yield is above the current marketplace. But none of that makes it right, wrong, good, or bad. You're just trying to accomplish. You have a mission. My mission is I have $100,000 or I have $1 million and I want 40 grand a year in income. Well, that's 4%. How do I get 4%? Well, the current rates are only 2.5. Okay, the current rates are only 2.5. Maybe I can buy a premium bond for 10 years that'll pay me net 4%. Yeah, I know it'll accrete down and I'll get a little less than I put in, but I need that 40 grand I described. So therefore, this is the strategy I'm using, right? So there's, again, people get so caught up in bonds are good, bonds are bad. You know, there's this old thing out there. There's an old formula that advisors used to use. If you're, take your age, subtract 30, add 7, I think pi is involved somehow, and that's how much you should put in bonds. Look, you buy bonds because you need income or you're not really fond of the risk that comes with stocks. Everybody's not cut out for risk, right? Mm-hmm. We talk a lot about risk on this show. We don't talk about it so everybody takes a bunch of risk. We talk about it so you understand it and its place in the world. Bonds have a place for people who are a little more conservative. Maybe they don't need a bunch of income. Maybe they don't need to earn 10% or 9% or 6%. Maybe they're content making 4 or 3. Maybe they're content making 3 or 4 tax-free, right? And we can talk about that. What is a municipal bond and why is it tax-free?
So a municipal bond basically is same thing. It's a debt instrument. But it is towards a municipal or, say, an entity in the municipality that is backed by either taxes or revenue. For example, if you have a turnpike that is being built.
We got one.
We have one.
Ryan, have you seen our turnpike?
I've heard tale of one.
Yeah, we got one.
Right. So you see when you pass down and then you get those lights taking pictures of you. And then that money goes out from your, what is it called, e-pass? Mm-hmm. Yeah. So when they build that turnpike, they will have turnpike bonds. Municipal bonds. These municipal bonds anybody can participate in, right? And the yield that you receive is backed by the cars that pass down and that money that being charged.
So your e-pass is paying the dividends to the person that owns the bonds.
So if I own bonds in the turnpike and I use e-pass, I'm paying myself. Found a loophole.
Oh, he's gamed the system.
Yeah. I have officially gamed the system. End of show.
Why is Ryan driving back and forth on the turnpike? Nobody knows. He believes this thing to be true.
I've also invested in the city, which is why I get speeding tickets a lot. It's very fun.
That's an excellent strategy.
Yeah. Yes.
The sad news, though, is that because the name fixed income, so you'll only get that yield no matter how many times you drive back. Unfortunately.
Got me again, Tammy.
Yeah, but hey, there's a really nice perk to it, though. Any yield you get is tax-free.
And that's only with like government municipal bonds.
Municipal bonds mostly, yeah.
And why is that important? Because if you're in a high tax bracket, and you say, well, you have a choice. I can either buy a municipal bond or a corporate bond, Coke or Pepsi or whoever it is. And you say, well, the corporate bond's paying 6. That's cool. And I go, yeah, but you should buy this municipal bond at 4.5. You'll be like, what? Why would I buy a 4.5% bond when I could get 6? Well, because you're in a high tax bracket, what we call the tax equivalent yield, but because you're not paying taxes, is actually 6.5% or 7%. So a good advisor, if you say I'm in a high tax bracket, should I buy municipal bonds? Well, let's figure out what your tax bracket is. We can do the tax equivalent yield calculation and tell you in 2 seconds flat whether the muni or the corporate makes sense. So any good advisor should be able to tell an investor whether they should go tax-free or not.
Pretty much, yeah.
And there's a lot of safety in munis, right? Because you do have the taxing authority of whatever municipality it is, right? So if you're the turnpike, where we're all driving up and down the turnpike with our e-passes, we know that's a pretty safe revenue stream. Oftentimes you can ask for a bond that's insured. There are companies out there that just insure them. So if the municipality were to default, which is rare, but it has happened.
Detroit.
Did Detroit default? They came close. They did default. Yeah. I know in Alabama there were some defaults. Yeah. There's some sketchy bonds out there. Illinois is always one that everybody's kind of nervous about. So the realities are there are things you can do to protect yourself in bonds and make sure that on average you're in pretty good shape and in a pretty safe place.
It all seems like it's like, what game do you want to play? You know, like if I'm going to a like state fair, right? They got the bunk, the hammer with the thing. I got the I could shoot the basketball, but essentially we're all winning the same bear. You know, the same stuff bear. That's when you describe the stock market, all the different ways you can do it. It's like, okay, do you understand this a little bit more? Is this way a little bit more fun? Well, here you go.
Mm-hmm. Here's your bear.
Yeah, my bear's bonds. I understand negative better than I understand positive. Do people do it that way?
Again, but everybody doesn't want a bear, right? Some people want a goldfish. So you have to understand that really it's not complex, but there's a conversation to be had about who you are as a person, what makes you comfortable. And if you say, look, I'd like to earn 8% a year, 7.5% a year, whatever the S&P 500 has earned for the last 70 years, and I'm okay with the ups and downs. It doesn't bother me to see my account go from 200 to 170 or 150 as long as I know long-term it's going to 300, right? And if you're that person and you say, I prefer that return and I'm willing to put up with that, then that's what you should do. You should buy stocks and use them for that purpose. But if let's say you're an older person, maybe you've heard the depression stories, it's not wrong to be uncomfortable with the stock market. It's not wrong. It's factually inaccurate, but it's not wrong to feel that way, right? We can't tell you how to feel. So if you feel like, listen, Scott, I get the stock market. I know I could probably earn more, but could you just send me a check every month? I only need to earn 3 or 4%. Then the bond market's a reasonable thing for you to talk about. It may not be all in the bond market. Maybe it's mostly in the bond. Who knows? But again, you begin with the end. If you come in and you don't say, I want a return, you say, I'm trying to accomplish something. You don't say, one person doesn't come in and say, I want to earn 8, and the other person says, I want to earn 3. Well, there's got to be a reason for that, right? It's not just a random number you're coming up with. So when we come back, we'll talk about how you come to that number.
All right, and we'll be back with more It's Only Money here on Real Radio 104.1. Remember, check out the website, edgewaterfamilywealth.com. There you can send us an email to edgewaterfamilywealth@raymondjames.com and check out all of the content on the blogs there. There's past shows. There's various videos that Scott has done. I've checked them all out. They're very good. The production value, awesome. And then, of course, financial talk with Tammy for all the fin heads out there. But we'll be right back with more It's Only Money. Welcome back to It's Only Money here on Real Radio 104.1 with financial advisor Scott Brown of Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website. I'm Ryan. Tammy, Scott's right-hand man, is here as well here in the morning. And we're talking beautiful, beautiful bonds, baby.
Said no one ever.
No, I don't think anyone ever said that. I'm trying to hype it up and make it more exciting.
We're going to be great friends, man.
Yeah, there's like one human being on the planet that gets excited about that, and that's Tammy. Yeah. Let's talk about bonds. Yeah. Really?
Does it get you going? Is that at a young age, Tammy, where you're like, yeah, I just love numbers? Because you always hear this. The phrase is always like, if you want to make money, you work with money. And a lot of people, they're very adverse to it. They're scared. They're like, it involves math, which for Americans already too much. You know?
Too much.
Yeah, but it's not too much math. It's more like logic and statistics. But it's not to scare anyone off.
Yeah, but you love it.
It's just passion.
He does. He does. He loves it. He gets giddy when you tell him to backtest something. He's like, can I? Really?
But you need that. That's what you want when you're a financial advisor. You don't want the guy going, oh, these numbers again with the statistics and everything. You want Tammy. You know?
Right, yeah.
Turn ESPN back on. No, so we were talking about beautiful, beautiful bonds, and we're talking about risk. And Tammy was threw out a term which I'll carefully dip a toe into, is the term standard deviation. And if you're an investor, you hear it. I think you do hear it. You might hear it from your advisor. You might hear it on TV. You might hear it from some guy in a $3,000 suit on CNBC or Bloomberg or whatever.
That's a nice suit.
Yeah, it's so there's it's one of those terms people use to sound important. The reality is it's just the variance in return, right? And we use that, Tammy, to determine how volatile a portfolio is going to be, right?
Yeah, risk.
And if you say to a client, the standard deviation is 14 or 15, what you're saying to that client is on any given year to year, the variance in that return could be 14 or 15%. So you might earn 2 and then you lost 13, or you might earn 17 and then the next year you made 2, right? That's a big variance or deviation in return. Yes? Mm-hmm. You with me so far?
I'm with you so far.
So a client may say, I don't know, that's not a boat I want to get in, right? That's going to make me seasick. Well, you said, well, we have another boat, and that's the bond boat. And the bond boat doesn't have as big a standard deviation. Now, it has standard deviation. It does deviate, right? But the deviation is more like 1 year you earn 7, the next year you earn 2, 1 year you earn 4, the next year you lose 1. That deviation, the waves you're on, are much more mundane. That's a 2 to 3 foot chop instead of 7 to 8 foot swells, right?
Yeah. Nice day cruise.
It is a nice day cruise. You can drink your beer and not fall over. But you, in return for the standard deviation you get with the stock market, you get that potential for higher return, which historically has come. Yes? So I think understanding what your advisor or the people on TV are saying is critical. And typically, Tammy, correct me if I'm wrong, we do 2 standard deviations is what's considered the normal acceptance level, meaning we figure 2 times out, that we take that deviation times 2 and consider those the most extreme conditions, although in the last 2 decades, I feel like we've had 4 or 5 3 standard deviation events. Those are those once-in-a-lifetime things that Ryan keeps experiencing.
Which we cannot see. Nobody can see. That's
right.
We call an abnormality in statistics.
Or a black swan.
Yes.
Yeah.
You cannot see that coming.
Yeah, 9/11 would be a black swan event that would be outside the, nobody sits down and does the math and says, well, Ryan, the best of our calculations, your upside is about 8.3% on an annualized basis. Your worst downside year is going to be 27% unless 9/11 happens. Nobody does that. Or a pandemic happens. These are 3 standard deviation type events. Nobody can predict them. They're famously in the book Black Swan. That's what Nisam Taleb is talking about in the Black Swan, is these events that we can't predict fall outside the norm. So whether that's good or bad, I don't know, because we, like you said, we seem to have them on a fairly regular basis.
Happening a lot lately.
Yeah.
I wonder if maybe that should be, you factor in every now and then. You're like, okay, 20-year period, this is how it would normally go. Let's throw a 9/11 in right around here.
Yeah.
And go with it. But no one's doing that yet.
It's like the people in the Midwest who said, this is my 4th 100-year flood. Well, that doesn't make any sense, but it keeps happening, right? So, yeah, I mean, again, you obviously can't account for everything, and that is investing. If you could account for everything, you wouldn't be investing, right? So that is, whether it's stocks with a deviation of 14 or 15% or bonds with a 4 or 5% deviation, you have to decide which boat you get in and why. And that goes back to how we ended the last segment, which is you don't take risk because it's fun, unless you're weird, right?
Yeah.
You don't.
There are people that do.
There are people that jump off of buildings in those bat suits and stuff.
I do wonder, though, if you're like a guy that like skydives off the side of the Grand Canyon, right? Like, would you get the same rush as like, you know what I'm going to do? I'm going to buy all these high-yield bonds.
Yeah. Woo, let's go. Well, and that's okay. That is certainly not wrong. But when you go into a conversation about why you're taking risk and why you have to take risk or don't, it's a byproduct of what you need. So again, if you walk into the office and you have $1 million and you say, look, man, I need $25,000 a year. I need $30,000 a year. That plus my Social Security and my pension gets me to a number that makes me comfortable. I can travel. I can do all the things I want to do. And I say, okay, great, Tammy. You came in. You gave me your $1 million. We can buy mostly bonds. If you want to add a few stocks, we can do that. It's not totally necessary. It's not risk I, as an advisor, have to take, or you as a client has to take, because you only need 2.5% to 3%. We've already discussed at the beginning of the show that the fixed or guaranteed rates, the risk-free rates, are in that neighborhood. So what that tells you is you don't have to take a bunch of risk to get your 25 or 30 grand. Now you may still say, hey, sprinkle a little risk in there so that my $1 million turns into $1.1 million or $1.2 million or whatever, but it's not critical. Conversely, Ryan, if you walk in with $1 million and you say, hey, man, I need 80 grand a year. I need this $1 million to produce me 80 grand a year. And I say, well, that's cool, but I'm going to have to take a lot of risk. The standard deviation you're going to be subjected to is going to be, that boat's going to be rocking. Mm-hmm. I'm not saying I can't get you 8. I'm just saying to have a chance to get 8, you have to take on an aggressive posture, and you say, okay, that's cool. If my $1 million turns into $1.4 million, that's great. If it turns into 750 grand, but you're sending me my 80 grand till I die, that's cool too, right? So usually most people are somewhere in between that, and that's why we end up with portfolios that have a little bit of stocks and a little bit of bonds in it, because we're mitigating risk, but producing the amount of income the person needs to go to the grocery store, to go out to a restaurant, to go to Europe once a year, to go on the Caribbean cruise, whatever it is, That's what we're trying to accomplish. So that comes back to what I always say about risk. The amount of risk you must take when you draw income from your retirement is a direct result of the amount of discipline and responsibility you've shouldered in your life up until that point. And what I mean by that, again, is if you get to the end and you're ready to retire and you've saved $200,000, but you need $30,000 a year, that's a high number for $200,000, right? That's some number that's really hard to get to. Yes?
12%.
Yeah, like 12%. So because you didn't, but if you saved $1 million because you were more diligent and responsible, then you don't have to take a lot of risk. So again, risk isn't bad. Risk is necessary. Risk is part of capitalism. It's part of free markets. It's what makes America go. But at the end of the day, if you come in and say, I don't want to take that much risk, but I want to earn 8%, those things don't go together. That is a nonsensical statement, right?
Yes. Would you say the riskiest thing you could do with your money, though, is to just like leave it in a bank account?
I mean, again, if you can, you can.
But
right?
are you you're literally losing money by doing that, right? Because you're fighting inflation, and so just every day your money is worth less. That's just how time goes, and then it's not making any money at all. So that seems like the riskiest move of all.
I mean, I can't argue with that. I can make a counterpoint to that, and which I don't think is applicable to most people. But the counter argument I would say, because again, this is this binary conversation, right? I mean, I make a living by people investing money. So understand, this is a very unbiased thing I'm about to say, which is you could, and it might work, right? Because if you said, you came in one day and you say, look, Scott, I'm going to walk the earth. I'm just going to camp. You know, I've talked the missus into it. We're just going to hike around the United States and we need $1,000 a month. And I'm going to do it for 10 years. And I have $120,000. Right? So that's 12 years. If you earn zero, you could accomplish what you told me you need to accomplish, right? You could spend $1,000 a month, and even if it made zero, you can get that job done. That success, as you defined it, was walk the earth, $1,000 a month, don't run out of money till I'm done, right? That was the goal you defined for me, and I said, yes, you could put the money in the bank, you could spend it down to zero, but you would not run out of money if you stick to your plan, right? Now, that's ludicrous. Most people wouldn't do that, and most people can't afford to do that. So what I find on average is people walk in and they say, look, I got $300,000, I got $800,000, or I got $1 million or $2 million, or whatever the number is, and these are my needs. Because, typically the needs are proportionate to the value of the account oftentimes, because the person who has $2 million probably made more money than the person who has 200, so they're used to living a higher standard of living, and they don't want to go down. Nobody wants to retire and do nothing. Right. So, if your $2 million needs to produce $100,000, that's 5%. It's not great, but it's fairly reasonable and fairly doable historically. The person with $200,000 says, oh, look, I need $10,000. That's also 5%. Right. So it's all proportionate. It's all context. It's all how do you want to live your life going forward? There's so many factors that go into it. And until we boil it all back to what we discussed, I believe it was last week we were talking about this, until you have that conversation with yourself and you say, I make this, I live this way, that's good, that's bad, okay, that's good. When I retire, I want to keep living this way. I'm looking at my left hand versus my right hand, and you say, I want to keep living this way. How much money do I need to put in a bucket or with an advisor or wherever, E-Trade, wherever you like to go, so that I can accomplish that thing? Until you have that conversation, everything we've just talked about is worthless to you. Once you have that conversation, it all becomes very important.
I guess, that's why you start at the end, which is, and you go backwards from there. That makes so much sense. When you first said that, you start at the end, I'm like, wait, that seems to be putting the cart in front of the horse. No, the end is where you want to be, and you work backwards from there. That's the biggest thing you've said that made sense to me this entire time I've been working with you, Scott.
You're welcome.
Yeah, thank you. And if you want more, if you want to become more enlightened like me, stick around for more It's Only Money here on Real Radio 104.1, and check out EdgewaterFamilyWealth.com as we come back from break. Welcome back to It's Only Money here on Real Radio 104.1. I'm Ryan Holmes, and I'm here with financial advisor Scott Brown of Edgewater Family Wealth, and his right-hand man, Tammy, is here as well. And it is the last segment of the show, and man, it just flown by. It's been beautiful. We've talked stocks, we've talked bonds, but I know there's more products out there, Scott. And are you shying away from those? Or how do you feel about like a mutual fund? Like my grandma loved mutual funds.
Your grandma's a smart woman. There's nothing, as I think we've discussed a few times, but I'll reiterate, is that there is no good or bad product. They're just how they're used, right? So mutual funds are a great one because they're diverse animals. So for a small investor, I think mutual funds make a lot of sense because you can't get if you have $100 a month to put into investments when you're young, which many of us did, myself included, we were limited into what we could save because life was expensive early on. It's a great way to diversify because if you say, I want to put $100 into a bunch of stocks, you can't. I mean, there's very few stocks that people would be enamored with right now, like Apple or Microsoft. Heaven forbid Tesla. You could get a seventh of a share, I suppose. Right? I do know they have the fractional shares now, which is kind of a mutual fund light idea. But if you buy a mutual fund, you can buy literally hundreds of shares by buying the shares of the mutual fund. So you get diversification from that. The cousin to that is the ETF. Yes, the ETF is a indexed product, which is kind of a stripped down mutual fund. If you think of a mutual fund like an active animal, where there's a person overseeing that mutual fund, they're buying Microsoft and selling Apple and buying Microsoft when they feel that's smart, as an example. Whereas an ETF doesn't do that. An ETF, on average, will just buy the index. They'll buy a basket of 100 stocks or 50 stocks or whatever their index is, and then they don't manage it. They just let it do what it does, kind of like the S&P 500. There are not numerous, but certainly a few ETFs that buy the S&P 500, and that's all they do, right? Because we know the S&P 500's earned 7.5% for a zillion years, and that's cool with people. Just why overthink it? Buy the S&P and call it a day. Go on a picnic, right? That's an ETF. Now, an ETF is cheaper. The argument for an ETF, there's a couple of them that maybe Tammy would like to talk about, but correct me if I'm wrong, Tammy, ETFs are cheaper, and they're typically a little more tax efficient.
Yeah, because ETF, there's something called expense ratio, and that's what the percentage charged off the total price of the product.
Yep.
So for a mutual fund, because you have an active manager, usually he would be more expensive because he's behind the scene moving stuff.
Sure, he's getting paid for his quote-unquote expertise.
Yeah, and sometimes that could be twice, 3 times, or even 4 times the cost of an ETF.
Well, on average, I would say, I'm going to guess, so don't hold me to this, but I think the average stock mutual fund probably charges about 75 basis points, 80 basis points. Is that? There is
that.
Yeah, and the average ETF's probably closer to 20 or 30 basis points, meaning 1/3 of 1%.
Yeah.
Yeah.
So that is, as you said, that is 25% of
that.
So it is pretty much cheaper.
Yeah.
And for tax purposes, because you mentioned mutual funds, they buy and sell positions within that one unit. Therefore, you'd see there's gains that are realized.
Yeah.
Therefore, by the end of the year, that gain realized in the unit will be kicked off to the client.
Yeah.
The owner of the mutual fund
has to pay the tax implications. By law. It's not like they're nefarious. They have to kick it out.
Exactly. And worst case scenario is when you have a down year and you have gains to pay on. So now you have a down year, your money is lower, and your market value, and you have to pay taxes.
Ain't that fun? So people, Ryan, people get a little bent out of shape when they have a negative return in a mutual fund and they have to pay taxes on the embedded gains from the year before, right?
I've seen that in the meme stock world where people would go on these like super highs and then the bottom would drop out, but because they made this gain of like, $1 million the year before, they have to pay on that.
Yeah, it's an embedded thing in mutual funds that people. Last year was a little bit of an issue with that. Although the funds weren't down, I don't think last year, but they were up. But still, the tax implications. So the point with the mutual fund is, and people again, we live in this binary world where things are good or bad. The reality is that's almost never true. What is true of mutual funds is they cost a little more than ETFs, and certainly more than just buying an individual stock. And for that, you get diversification and professional management. The downside to that is A, again, they cost more, and B, you're a little less in control of the tax implications if it's not in an IRA or a qualified account. And what I mean by that is in a qualified account, it doesn't matter because you don't pay taxes till you withdraw. So just be aware if you're buying a mutual fund, look and see what it costs. Be aware of that. Know there's also trading costs inside of a mutual fund that are a little hard to figure out. And that can be, the more they turn that portfolio over, if they're turning it over 2 or 3 times a year, it's 100% of a small cap fund or an international fund where they're turning it over 2 or 3 times a year sometimes, that can get expensive in terms of trading costs. And know that in an ETF, the advantage is it's cheaper and it's indexed, and you still get to participate in the markets that some people, I am not one of them, would argue that they're not as good as a professionally managed fund. Now, I'm about to tell you something crazy, Ryan. It's going to blow your mind.
Okay.
Keep your market cap on.
I got my market cap holding it tight.
Yeah, is that historically 85% of all mutual fund managers fail to beat their given index in any given year. So that means 8.5 out of 10 managers get to the end of the year and get beat by their index. So they're paying them does seem a little bit crazy.
Yes, because they're not. Is it that they're not good at it, or it's just?
That's part of it. Part of it is that it's a little overhyped what a professional can bring to you in terms of stock selection in any given year. I'm not diminishing stock selection because we do some of that too, but it's more of a long-term situation where we're evaluating stocks for a longer period of time. But year to year, it's difficult for a manager to beat the index. One of the reasons it's difficult is they have to keep cash on hand, right? That drag, I call that cash drag. That makes it difficult for the fund to beat its index if 5 or 10% of its money's in cash. Why do they keep 5 or 10% in cash? Because they get redemptions. And if they get a redemption, they got to pay the people who want to get out, yes? And in a down market, it gets real ugly. Because if they have massive redemptions because people are bummed out and running for the hills, they have to keep selling stuff that's down to make the cash in order to pay the people, yes? So that's a difficult situation. They're not as tax efficient, and they are more expensive, and oftentimes they're just not even as productive as the index itself, which is why I think ETFs, if you want diversification, in my not so humble opinion, is probably a smarter way to go. The other products that people talk about are annuities, right? Annuities, if you say annuity to somebody, you're going to get a strong reaction one way or the other, usually to the negative, because people have heard so many bad things about them. And I would argue that they deserve some of that nefarious reputation.
You think so?
I do, and not because the annuities are evil, but because the reasons they're often sold are because they are high commission, or historically, not so much anymore, but used to be very high commission products to the insurance agent or advisor that was selling them to you. That does not mean, however, they're bad. It just means they were used for the wrong reason. So annuities will typically cost you, depending on the death benefit or the living benefit, and we can talk about that in a second, typically between 2 and 3% annually. Some of them even higher, depending on what benefits they have. But remember, annuities come with guarantees. So if you're a person who says, I want to put $500,000 into something, and if the market turns it into $400 and I die, I want my heirs to get $500, that's a benefit of an annuity, right? If you had a mutual fund, you put in $500, you die, it's worth $400, your kids get $400. There's no insurance feature in a mutual fund, typically, right? Now, the mutual fund's cheaper, but what you get for the higher price in the annuity is the death benefit. I'm not saying that's right or wrong. I'm not trying to convince anybody they should or should not want that. That would be up to the individual. But
all I know is there's a lot of commercials out there with a song that if I wanted to get, send it to somebody, I could sell my annuity off and just take a lump sum.
Yeah.
Those
are like, what are those? Those are the settlement people, right? If you won an award where you get $1,000 a month, some company will call you up and say, "Hey, we'll buy that $1,000 a month off you for $50,000," and then some Yahoo goes out and buys a bass boat, and then their money's not coming in anymore. And I have seen that a lot of times. So you want to be careful there, bass boat boy. But yeah, so annuities aren't evil; they're just more expensive than mutual funds. Mutual funds are more expensive than index products, and if you just buy stocks outright. In a non-managed situation, if you just said, I'm going to buy Microsoft and I'm going to buy Amazon whenever I have some spare money and I'm just going to keep it in my trading account, the cost of that is typically not free, but certainly minimal by comparison.
Now, I'm just going to ask a selfish question because I found every industry has this. And like I'm in comedy, right? Like I can tell like a hacky joke, right? Like almost immediately. BS meter strong in the comedy world. Imagine you have the same thing. Before we get out of here, what's the hackiest piece of financial advice that you've heard or hear regularly?
Well, again, the hackiest thing is that I can pick better stocks. That if you come, and we talked about this a few weeks ago, if somebody walks in and they say, a lot of times people go in, I would say more often than not, people go in with the wrong impression of what they should want from an advisor. And the problem is most advisors will tell them what they want to hear in order to get their business, right? Hey, can you pick the best stocks for me? Because my other guy sucks. oh, yeah, I would have never bought those things that advisor bought. Then they hired this guy. The market goes down again. They fire that guy. They go to the next gal. She says the same thing. So the hackiest thing a person can do in my business is agree with somebody just to get their business. Because invariably, that will go wrong. You will be found out, and that people will leave upset. And to me, that's probably the equivalent of a fart joke in your business. I started to say something else, but then I realized I probably shouldn't.
I gotcha. Well, this has been It's Only Money here on Real Radio 104.1. If you want to get a hold of Scott or Tammy, EdgewaterFamilyWealth.com is the website you want to go to. It has all of the info from Contact Us to the blogs to Financial Talk with Tammy, all of that good stuff and more. And you can email the show, EdgewaterFamilyWealth@RaymondJames.com. My name is Ryan. I'm hanging out with Scott and Tammy. Scott and Tammy, have a wonderful week.
You do the same.
You as well.
All right. See you next time on It's Only Money here on Real Radio 104.1.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, there are people, there are regular people.
Now that guy I trust. You
Yeah,
see the problem, Scott? You don't have a monocle.
Monocle is, now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.